More importantly, a quarter-point rate cut will have a much larger impact on the market than it does on the economy. That's because money managers have seen this movie before. They have what I call a playbook. It's a playbook for what to do when the Fed starts easing. You sell high-growth stocks that can thrive in any economic environment. And you buy the cyclicals, the industrial companies that can deliver big earnings beat when the economy accelerates because the Fed cuts. Now, here's the thing. Here's the thing about the playbook. It could be wrong. Maybe a rate cut won't boost auto sales. So you shouldn't buy industrials with auto exposure like 3M or Illinois Toolworks or Lear. Maybe it won't trigger more construction. So you should avoid Caterpillar, United Rentals, or Union Pacific. But, and this is the world's biggest but, it doesn't matter right now if the playbook's wrong. Money managers know that you don't fight the Fed, you don't fight the tape, which means you don't go against the playbook that says buy every one of those stocks. What does it mean for you? Okay, last week Caterpillar reported a subpar quarter when many people, including myself, mea culpa, thought the numbers would come in better than feared, or BTF. It didn't work out that way, and the stock got slammed, falling from 138 to 131. However, CAT is exactly the kind of stock the playbook says you must buy it with your eyes closed because of the rate cut. And now it's making a comeback. A buck and change today. So as CAT goes, by the way, so go the other industrials. CAT has more pin action than any stock I follow. How about the super growth stocks? Oh, they got pummeled again today. Something that's become a common theme ever since ServiceNow and PayPal reported numbers that Wall Street didn't like. I actually thought ServiceNow delivered a good quarter. We heard from CEO John Donahoe last week on the show. He told a compelling story. Do you know, I went back over it again today. I thought maybe I missed something. I said, okay, let me just reread the transcript. Let me reread the speech. No, it was great. However, the playbook is spoken, and that's why the stock's down a quick $12. PayPal, on the other hand, actually deserves to go down as the company cut guidance. But the pin action from these two has been extreme. And it's all thanks to the Fed-induced rotation. Don't believe it when people say the stocks going down must mean the companies are slowing. It's not. It's the rotation speaking. So what should you do about this rotation? Honestly, while I want you to be aware of what's going on, hence what I've just been talking about, I think it's a mistake for you to try to trade this kind of rotation if you're a home gamer. Matter of fact, I'll go one step further. The stocks now that are going down are the highest quality companies in this entire market. CloudKings, Salesforce, Workday, VMware, Splunk, Twilio, Adobe. These are excellent companies, but their stocks rarely give you any kind of viable pullback. When you see a Fed-induced rotation like this one, it means you can finally buy the CloudKings at a discount. But remember, there's no hurry. We have to let the whole rate cut drama play out. There are always late to the party fund managers who will only figure out what I just told you after the Fed takes action on Wednesday. And maybe that's when you make your move. And the cyclicals, look, they're cheap. They might see better business. There's a cyclical scarcity out there, just not enough stocks. But you have to deal with the endless trade talks with China, and I don't necessarily think they'll be fruitful. If the negotiations blow up, that will stop the industrial rally in its tracks, regardless of the Fed. But the turbocharged growth kings, come on, they'll do fine no matter what, because they're riding the greatest secular trend out there, the digitization of all business. More on that later. Bottom line, you need to accept that this rotation is happening. It's what's driving these stocks. The Fed's rate cut will push money out of the CloudKings and into the industrials. But your job is not to trade around a rotation. It's to find high-quality stocks and stick with them for as long as the underlying business stays strong. So when this kind of rotation gives you a pullback in a group like the CloudKings, that's a long-term buying opportunity. Just remember that you can afford to take your time. Again, there is no hurry. But you have to start sometime. And as it goes on, I don't think the rotation's over. This rotation will be the best time to buy the stocks that we like so much in Mad Money.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.